In this video, we're going to be performing a deep dive on Johnson & Johnson's dividend safety. To begin, let's talk about Johnson & Johnson's business model. Johnson & Johnson is a diversified healthcare company and a leader in the area of pharmaceuticals, medical devices, and consumer products. Johnson & Johnson was founded in 1886 and employs more than 125,000 people around the world. The company generated more than $76 billion in revenues in 2017. Johnson & Johnson is a well-known dividend stock because of its compelling track record of dividend growth. With 55 years of consecutive dividend increases, Johnson & Johnson is a member of the Dividend Aristocrats, a group of elite dividend stocks with 25-plus years of consecutive dividend increases. In fact, Johnson & Johnson satisfies the requirement to be a dividend aristocrat more than twice over. The company's 55 years of dividend increases qualifies it to be a dividend king, a group of dividend stocks with more than 5 decades of dividend increases. Looking ahead, recent developments regarding an asbestos lawsuit that Johnson & Johnson is involved in has led many investors to question the safety of its future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from 4 perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. Please note that we are not making any predictions about the lawsuit's outcome in this video, as we believe it's too early to be certain of what the implications will be for Johnson & Johnson's investors. First, let's discuss Johnson & Johnson's dividend safety in the context of the company's current earnings. When Johnson & Johnson announced its third quarter financial results on October 16th, the company reported that it generated adjusted earnings per share of $2.05 in the 3-month reporting period. Johnson & Johnson currently pays a quarterly dividend of 90 cents per share, which implies a payout ratio of 44% in the most recent quarter. Looking out with a longer lens, our conclusion is the same. Johnson & Johnson is likely to generate adjusted earnings per share of $8.16 in fiscal 2018 and is on pace to pay $3.54 in dividends during the same time period, for a full-year payout ratio of 43%. Using earnings, Johnson & Johnson's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Johnson & Johnson's current dividend payment to its free cash flow. Through the first 9 months of fiscal 2018, Johnson & Johnson generated $16 billion of cash flow from operating activities and spent $2.4 billion on capital expenditures for free cash flow of $13.6 billion. Johnson & Johnson distributed $7 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 51%. Using free cash flow, our conclusion is the same as when we use earnings to measure Johnson & Johnson's dividend safety. The company's dividend appears safe for the foreseeable future, and we have no concerns about its ability to pay rising dividends moving forward. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Johnson & Johnson's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Johnson & Johnson's performance during this time period is shown here. Johnson & Johnson's earnings per share rose each and every year of the last recession. With that in mind, we have no concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess Johnson & Johnson's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. In fiscal 2018, Johnson & Johnson generated $175 million of interest expense and had $31.3 billion of total debt for a weighted average interest rate of 2.2%. The following image shows how changes to Johnson & Johnson's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Johnson & Johnson's weighted average interest rate would need to rise well above the 20% level before its dividend would no longer be covered by free cash flow. Accordingly, we believe that Johnson & Johnson's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Johnson & Johnson's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover ShareDividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.sharedividend.com.